And move right on to a corporate voice. The management of Westlife is here to talk about their same-store sales guidance as well as their plans for scouting buyouts. Amit Jatia, he is the Vice Chairman, Westlife Development. Good to have you on board. Thanks so much for joining in. Now, the growth trajectory for the company in terms of SSSG growth is at about 6.7%. You've spoken about a guidance of 7 to 9%. So what has really led to this shift? Has there been an improvement in the consumer sentiment or an increase in your footfall in sales?
Well, the guidance is really more of Vision 2022 that we had laid out in 2016. And while last year we for the whole of FY19, we did about 17 or 18% same-store sales growth. Obviously, we've over the 3 years compounded by almost 50%. And on top of that, last quarter was 6.7. So we feel a more sustainable number is the 7 to 9% that we've talked about. I think that's not to do with an immediate economic situation, whether GDP goes up, GDP goes down, consumer sentiment is good or bad. We do believe that that's the number that we are gunning for, and we are pretty confident of sort of getting there.
Okay, fair enough. So this is, a down-the-line strategy and target that you've got in place for your same-store sales growth. But this is coming at a time when, we have seen a slowdown, a marked slowdown come in overall consumer spending. So what is the outlook then, as per this vision on same-store sales growth on your margins? Do you think that that could likely be compromised?
Absolutely not. Not only will our margins not be compromised, but we have maintained that we will deliver Vision 2022. So year on year, 7 to 9% same-store sales growth, whatever the economic conditions are. As a company, we've organized ourselves to be able to do that. And similarly, margin growth, what we've talked about is from the current 9%, we expect to get to between 13 to 15% by Vision 2022. And that means that if I look at last 3 years as an example, we've done about 130 basis points improvement year on year. And we expect to continue to improve our margins, by about 80 to 120 bibs a year, so that we can deliver the 13% that we've talked about. Yeah, my basic thinking is that economies today and is very fast changing. And like last year was a great year, consumer sentiment was excellent. That started changing a little bit in the first quarter. And therefore, companies have to organize themselves to continue to deliver their growth numbers while navigating that. Especially the advantage for us is that we are in a sector which we call the informal eating out market. And within informal eating out market, there is the Western fast food part. And the Western fast food market continues to grow quite nicely, even through this economic downturn. So we see a double-digit growth in the consumer usage of Western fast food. And given that we are sort of leaders in that space, we are confident about this 7 to 9% that I talked about.
Okay, now you've also targeted a 25 to 30 store expansion annually. Can you tell us a little bit about how many stores you've added in Q4 and whether you're on track?
Yes, we are on track. I mean, we had said that we will be at between 400 to 500 restaurants by Vision and our Vision 2022 document. And essentially, we are already at 300. So over the next 3 years, we need to build about 100 restaurants. And we are very confident that we are on that trajectory and on that plan. Year on year, we do between 25 to 30 a year. So we are quite on track to deliver that as well.
Okay, sounds good. What is the profitability of the stores in the break-even period?
So, we don't share individual store break-even points, but essentially we invest about 25 to 30 million rupees per restaurant, and typically we achieve cash flow break-even in the first year itself. This was after implementing this cost reduction project that we had done in 2016. And fortunately, we've been able to maintain those economics through the last 3 or 4 years. So given that we are now cash flow break-even in the first year, by the third year, we look for about 20 to 25% cash on cash return at the restaurant level. That means after adding back depreciation and meeting all the costs at the restaurant level, We look for 20 to 25% by the third year. So again, we are quite good with unit economics. We've kept a very, very tight focus on keeping costs under control because inflation has been a challenge. But as a company, our DNA is to take at least 150 bips of cost out every year. So again, we are pretty all right in that area as well.
And, we've got the festive season around the corner now. There's been an attractive launch of the McSaver pack. How has that been performing? What kind of sales are you expecting in the festive season?
Yeah, so, we had launched our value platform in April, and fortunately it coincided very nicely with the bit of headwinds that we started seeing. And if you would notice that the 6.7% same-store sales growth in the first quarter was pretty much top of the charts from an industry point of view, because it was on top of the 25% we had last year. So we have sort of renewed the offer after taking consumer feedback, and we are very, very hopeful that it will be a good festive season for us and our consumers. If consumers like it, then obviously it works out well for us. So we are very bullish with this new value platform that we've tweaked for our consumers, and initial feedback has been quite good, and we are quite pleased with where we are.
Okay, thanks very much for sharing with us the vision, the outlook for the festive season, as well as your targets and financials. It's been lovely interacting with you. Tell you what, we'll slip into a very short break. Stay with us for more on the other side.